The Opendoor story just keeps getting more interesting, and as we head into Wednesday's session, it's clear that we're approaching a critical moment for this stock. First and foremost, I want to reiterate that the proposed reverse stock split is, in my view, a complete non-event. It's not the thing that's going to define this rally or stop it. And at this point, it may not even happen at all. The company's share price has already rebounded well above the Nasdaq's minimum listing requirement. We're sitting in the $2.80 to $3.20 range right now, and the fact that we hit nearly $5 earlier in the week is proof of just how powerful this retail-driven momentum has become. We've seen this kind of action before with other meme plays, but Opendoor is different in a few key ways. There's more to the story than just sentiment and short squeezes, though those are absolutely fueling the rally. At its core, Opendoor still has a business model that benefits from one major macro trend, and that's the recovery of the US housing market. And lately, we've been seeing signs that the tide may be turning in a meaningful way. Mortgage rate forecasts are showing a potential shift. Experts from Fannie Mae to the Mortgage Bankers Association believe that rates will gradually ease into the low 6% range by late 2025, with some even suggesting they could fall below 6% by early 2026. That's huge. When borrowing gets cheaper, housing activity picks up. And when homes are changing hands, that's when Opendoor's model can really start to work. More volume means more revenue, more opportunity to drive margin, and more investor confidence. Now let's talk about what I think is the true upcoming catalyst for this stock, and it's not the special shareholder meeting next Monday. It's the company's next earnings report, scheduled for August 5th. That's where the rubber meets the road. If Opendoor shows even modest improvement in margins, revenue growth, or provides guidance that reflects the improving housing outlook, this stock could absolutely explode again. And if you think $5 was the ceiling, you might want to think again. I still believe that a move toward $20 is on the table, maybe not in one day, but as part of a broader rally leading into and potentially following earnings. In terms of the reverse split vote, there are a few scenarios to consider. A cancellation of the vote would send the stock flying. A no vote would also reinforce confidence in the retail community. A yes vote where the board chooses not to enact the reverse split is likely the most realistic outcome, and even that wouldn't necessarily kill the rally, especially if it's paired with positive forward guidance. The worst case is a yes vote followed by an immediate reverse split, but given the current share price, I think that's now highly unlikely. Another thing to point out is that Tuesday's dip to around $2.88 happened on significantly lower volume compared to the explosive sessions we saw earlier. That tells me a lot of people are just sitting on their positions, waiting for clarity from the vote and the next phase of the rally. I actually doubled down during that dip, because I think there's still serious upside left in this play. So heading into Wednesday's market open, I remain bullish. Yes, there may be more volatility, and we might not shoot straight up every day. But this isn't over. In fact, I think it's just entering its next phase. The rally has legs. The reverse split is no longer a threat. And the housing market, slowly but surely, is showing the kind of signals that could transform Opendoor from a meme play into a legitimate turnaround story. Stay sharp, stay focused, and let's see what the market brings.